It's time to dig into the case studies and see how the numbers play out. In this scenario, the homeowner has a $500,000 mortgage on their principal residence. They use the mortgage to buy the home, so they're not currently getting any tax benefits on the debt. They're on a 30-year amortization at 5.45%, which means their monthly mortgage payment is $2,804. Their marginal tax bracket is 40%, which means that for any debt they convert to a tax-deductible investment loan, they'll end up getting 40% of the interest back every year at tax time. The rental property is worth $500,000. It has a mortgage on it with a balance of $375,000, so there's $125,000 in equity. And the total annual cost to run the property is just over $33,000 annually, or $2,753 per month to be precise. The expenses include $25,000 for mortgage payments, principal and interest, $5,400 for maintenance, condo fees and insurance, and $2,400 for property taxes. In a moment, we're going to explore a few different scenarios. For each one, the principal residence, the rental property, and the homeowner's financial profile will remain exactly the same as what is displayed on the screen. What we will do is provide a separate analysis based on these numbers for three different scenarios. The first scenario will be that the homeowner already owns the rental, so they don't need to borrow the down payment, and we are simply reorganizing the cash flows in a way that improves tax efficiency. The second and third scenarios are when the homeowner purchases the rental and borrows the down payment from their investment line of credit. We will look at how a rental purchase plays out when the property is cash flow positive and when it's cash flow negative. Let's take a look at the cash flow cycle again, but this time with the numbers from the case study. We've got the principal residence in the center, and we're making regular mortgage payments of $2,804 monthly. The payment comes from the homeowner's regular household bank account, same as it does today, no change. Up above, we've got the rental property, income on the left and expenses on the right. We receive just over $33,000 in rental income annually on the property. That's $2,753 each month that we can use to prepay the mortgage and drive that non-deductible debt to the ground. That equity becomes available in the investment line of credit, and we draw that same $2,753 back out into the rental checking account. From there, we use the funds to make all the payments on the rental property. That's the cycle. Every single month, we get our rental income and run it through the primary residence mortgage, convert bad debt over to the tax-deductible side of the balance sheet, and draw the funds out to pay our rental expenses. Here are the financials for the scenario where the homeowner already owns the rental property and does not need to borrow the down payment. The first thing we look at is how long it takes to move the full balance of the mortgage over to the investment line. We call this debt conversion, and depending on how many properties there are, it can typically take anywhere from 6 to 12 years to complete this first phase. In this case, debt conversion is achieved in year 9. This doesn't mean that the mortgage is paid off. It just means that we've reached the point where the debt is completely tax deductible and we're receiving our maximum annual tax refunds. The next thing we look at is the total value of the refunds earned in the plan. This assumes the rate of interest is constant and the marginal tax rate doesn't change either. In reality, these things can fluctuate, but this gives us a sense of the total amount of tax refunds we can expect to achieve using this strategy. In this case, the homeowner receives $117,000 in refunds over the life of the mortgage. Technically, the homeowner is mortgage-free 97 payments sooner than they otherwise would be. And in order to provide an apples-to-apples comparison, we assume they continue making payments and reinvest those 97 payments to the end of their original amortization, so they can earn a rate of return on the future savings. The calculator allows us to play with different growth rate assumptions, and for this scenario we're using 6%, which results in a future value of the invested payment savings of $348,969. We also calculate the future value of the rental, which is $1.2 million. There are no outstanding liabilities. The investment line of credit and the rental mortgage are both paid in full. And finally, we see the net wealth improvement of $348,000, which is essentially the future value of the 97 monthly payments at the 6% growth rate. It's worth noting that our calculator allows us to include or exclude the rental property value depending on the circumstances. In this scenario, the homeowner already owned the rental property and would have benefited from the value appreciation with or without this strategy, which is why we are excluding the rental value in the net wealth improvement. Moving on to the next scenario. The homeowner had a negative net worth of $47,000 at year 4 and they have been working at it for 30 years. So, let's see how we would feel if we had $47,000 at this point. As we can see, with the 10-year plan, they have a net worth of $1 million at 65. So, it looks like our plan is working. However, as we know, there is no guarantee of this outcome. It's important to keep in mind the longer you work, the better your outcome. As you can see in this graph, the more years you work, the more money you have saved. Therefore, if you work longer, this is a scenario, the homeowner purchases a rental property for $500,000 using $125,000 from the investment line for the down payment. The property is cash flow neutral, meaning the rental income is sufficient to offset the expenses for carrying the property. Debt conversion occurs a little faster this time, coming in at 8.4 years. The reason for this is because we borrowed the down payment, which results in higher initial tax refunds. And because we use the refunds to pay down the mortgage, the conversion process is accelerated. Over the life of the plan, we see $259,000 in tax refunds. Again, because we're borrowing more and it takes longer to retire the debt, we have a longer time horizon for earning refunds. Keep in mind, we're not adding any additional funds to service the borrowed down payment. The structure is covering the payment for us, which is why we see a reduction in payment savings from the previous scenario. Overall, we're still ahead of the original amortization, which is reduced by 8 payments, totaling $20,000. Factoring for tax, that's an income savings of $37,000. Growth rate assumptions are the same as the previous scenario. In fact, we keep growth assumptions the same throughout all scenarios for consistency. Here, we have the future value of the payment savings. And in this scenario, we're including the value of the rental because we acquired the property as part of the strategy, which gives us $1.2 million in additional wealth creation. The investment line of credit, the rental mortgage, and the primary residence are all paid off, leading to a net wealth improvement of $1,244,000. Again, it's worth noting they were able to acquire the property, self-fund the down payment, plus cover all rental expenses without any additional cash inputs beyond the regular monthly mortgage payment on their home. And finally, Scenario 3. The same rental purchase, but with negative cash flow. You might recall the rental expenses on this property are $2,753 monthly. For this scenario, we're assuming the rental income is $2,300, which means there is a monthly shortfall of $453. One thing worth mentioning, our calculator allows us to make some assumptions for cash flow appreciation. Rents never really stay static forever. The value of the rent you earn, as well as the expenses on the property, tend to grow over time. We don't need to get into the weeds on this, but our calculator takes these changes into account. All of the scenarios we covered so far include a 1.5% cash flow appreciation rate, which means even though the property started out by losing money, it slowly improves over time. But it still takes a while to get back to positive cash flow. For this scenario, the property runs at a deficit for just over 15 years. What's impressive about this is that we are able to purchase a property where the expenses are higher than the income and still have it make sense financially. The structure covers the shortfall through the investment line of credit, which allows us to own the property without having to make concessions elsewhere in our lives. Earlier in the course, we talked about having to choose between our lifestyle today and investing for tomorrow. With the rental cash damming strategy, it's possible to do both. All right, here are the results. Debt conversion, 9.17 years. Tax refunds, 423,600. Growth assumptions, same across all scenarios. Future rental value, no change, 1.2 million. Outstanding liabilities, this is where we begin to see a difference. The investment line of credit has a balance remaining of 343,000. That's because we ran negative cash flow for 15 years, and we drew on the investment line to cover the shortfall along the way. Now let's take a look at net wealth improvement. Remember, we're comparing the timeline against the original amortization on the primary residence mortgage, which is 30 years. At that point in time, they have the rental property worth 1.2 million. We subtract the balance remaining on the investment line, 343,000, which gives us 877,000 after paying out the balance on the line. Again, thanks to the tax efficiency of the plan, combined with the ability to leverage the structure to service the cash flow obligation of owning the rental property, the homeowner is able to make serious headway on their wealth improvement without affecting their personal cash flow or their lifestyle.